All right, fine. So everybody said 2. My answer is also 2, right? If you follow my commentary, video blog, live trading room, I've been bearish since last, for the past 18 months, continue to be bearish. Timing is very difficult, right? I actually thought we're going to be much lower. If somebody in October told me that we're going to be at 414 in April, May, I would say that that's just impossible. But, never say never. Timing is very difficult, right? But again, I think there are more, in December, there were less bearish arguments. Now that we do have issues with liquidity and default swaps and debt ceiling, there are just a lot of evidence that economic conditions are deteriorating, and inflation is still persistently high, right? We got some inflation data from France, Italy, and we see stagflation in Germany. So lack of growth in Europe, still high prices, right? Consumers are still binge spending, right? That's kind of the theme. So inflation is not going anywhere. Interest rates are not going anywhere. That means that at some point, the revenue of these companies will continue to decelerate. So my answer is 2, right? My answer is also 2. The next question becomes, well, if it's 2, will this level hold, right? Will the 350 level hold, right? Yes or no? I'm going to put down no, right? I'm in the camp where going into summer is very volatile. Then we have July. Usually there is a rebound in July, but then we have September, October, which are usually a bearish time of the year. And I think between now and September, we will retest this level probably multiple times. And at some point, we will break down either during summer or during September, October. That I'm not going to try to predict. It's very hard. But based on earnings and based on interest rates decision, we have Fed decision next week. Sooner or later, I think the October lows will give away. All right. So that's my view on the market. Any questions about my opinion, subscription, dollar, interest rate? Watch interest rates, right? I think bond market has been correct. Equity market has these gyrations, but the bond market is more accurate, right? So yield continue to drop, right? Despite consumers spending a lot of money and being healthy and wage growth, unemployment is low. How do you reconcile this? That basically says that the bond traders or bond market believes that Fed will pivot, right? Fed will pivot and start lowering interest rates. But then why would they do this if consumer is still healthy? Well, because again, at some point there will be evidence of recession, right? And the demand is going to drop, recession is going to subside even more. And the magic line is this 3.3%, right? We've knocked on the door of this many times, right? It started basically in December, then January, March, February. So we continue to kind of decelerate, making lower highs, lower lows. I think the pullback need to have 2 conditions. One, interest rates have to drop below 3.3%. Then you know that the pullback will accelerate. And then one of the strongest soft landing dollar narrative is that dollar has been weak since October, right? It's been extremely high. Then it pulled back and it stays on this level, right? So for pullback to accelerate, both the interest rates have to drop and the dollar has to rally. Until then, we're just going to see these kind of range bound trading.